Welcome to the Mind Your Business Show. I'm your host, Tony Calloway, your private money godfather, and today's topic came from a viewer. Tay, this one's for you. The topic we'll be discussing is limited liability company or corporation. That's a good question. So go grab your pen and paper and we'll be right back. Welcome back. I'm Tony Calloway, your host for the Mind Your Business Show. And as I said in the intro, today's topic is limited liability company or corporation. That's a good question. A lot of people who go into business ask that question. In fact, our viewer Tay, as I keep asking you guys, tell me what you want me to talk about, wanted me to break into this topic and help to get some insight as to which of these would be best for you. So if you're ready to learn something, I'm ready to teach something, so let's get going. Now, what we're going to discuss in this episode is that we're going to understand the differences between a limited liability company and corporations, the characteristics of each structure, and I want to answer some of the common questions related to forming a business entity. Now, I had been a college professor for, getting close to 30 years, and I love teaching. And as much as we talk about business, how to operate a business, how to start a business, very seldom is there any in-depth discussion outside of an academic setting as to how should I form my business. So I think by the time we finish today, you're really going to have a good understanding. And I like to start first with, we got to understand the terms. We have to know the definition of what words mean. So we're going to start off with the general classification, the definition of a business entity, and that is a legally recognized organization that conducts commercial, industrial, or professional activities with the aim of earning a profit. So now when we say business entity, that term incorporates both limited liability companies, corporations, sole proprietorship. So we're talking about a business entity, but now take that out about the sole proprietorship. It's the limited liability companies or the corporation types, because those will have their own identity as far as Uncle Sam's concerned, and a lot of other aspects related to business. Now, business structure is how business is organized according to the legal status, and will indicate who owns the company, how profits are distributed, and how it will be taxed. Now, this is where we started getting into the question, limited liability company or corporations. Now, there are 5 basic types of business structures, and we're only going to talk about 3 of them today, but we're going to start with sole proprietorship. Now, that is you going out, starting a business under your name with your social security number. Now, you might get a DBA or doing business as, but basically, for all intents and purposes, all assets, liability, and tax relate to you as an individual. And any income that the business generates or any losses that the business generates are just like you. They're filed on your personal income taxes. Now, the one at the very bottom, which I'll skip down to, is nonprofit entity. Now, nonprofit entities are unique in many regards, and most people want to start for-profit businesses. So we're going to focus on those middle 3. The limited liability company, the subchapter S corporation, as well as the subchapter C corporation. So now, this episode is sponsored by your favorite business, the Private Money Syndicate, where we power dreams with private money. So please reach out to us at privatemoneysyndicate.com by scheduling a consultation, or you can give a call at 706-888-3719. Now, here's the definition of a limited liability company. We're going to start off with those. And I've got 3 segments to it, so here's the first part. I want to make sure I can get them all on the slides. The first is abbreviated LLC, limited liability company. So whenever you see LLC, that's what it's referring to, is a business structure that protects its owners from personal liability for the company's debts. So in other words, this entity, this LLC, becomes something all into its own. It can own property, it can have obligations. For example, it can take on debt, but those are apart from the owner or owners of the LLC. The second part is they separate the owner's assets from the business assets, protecting personal assets from business liability in the event of bankruptcy or lawsuit. So again, I would be apart from my business. So if there was anything that caused me to be subject to any kind of lawsuits or failure to pay back any debts and the LLC were to go bankrupt, that does not impact me as long as, now this is key, it's not on the slide, as long as I have not personally guaranteed any of these obligations. Now, personal guarantee means that in addition to whatever the LLC is able to be able to take on, I am personally responsible as a guarantor for that. So if you, in fact, I got a client right now, he's a real estate developer. We've gotten a number of loans approved for him, but they were all recourse, which means they would have required a personal guarantee, and he doesn't want to do that. And here's why you don't want to do that before I proceed. If you personally guarantee a debt, that means that it really encumbers anything you otherwise would be able to do as far as being able to take on debt, because in essence, if you were to fail to make that obligation, then they're able to, take whatever assets or collateral, and then if there were any other creditors out there, they'd be up the creek. So oftentimes, creditors don't want to come in behind personal guarantees when we're talking about business. Now we're talking about business, not personal stuff. So again, the limited liability company allows you to separate so that what's going on in your business, if you have not personally guaranteed it, is totally separate from what you're doing in your personal. So let's just suppose that you would want to go out and buy a car after you formed your LLC. Well, aside from a credit pull, which they would probably do, they would not see that you had $50,000 of debt on your LLC because it does not show up on your personal credit report. So buying a house, buying a car, doing anything else you want, that's over here, totally aside from your business. So that is an important separation for the purposes that I just stated. Now, the third thing is that LLCs are always also taxed as pass-through. Now, that means that the profits and losses are filed through the member's personal tax return. Now, you say, well, Tony, I thought you just said that this was separate from the individual. It is, but you get the benefit by this pass-through. So let's say that the company had a profit, well, then you will report that profit of the LLC on your personal tax return. Or if there was a loss, you would be able to take that loss out of what you would actually earn if you had any other income, which would reduce your taxable income. So this pass-through is basically saying that it's like it's you, but for all instances where there's any liabilities or obligations, the LLC is shielding you from being liable for any of those things. So that's the LLC. That's the first one, limited liability company. Now let's talk about subchapter S corporations. Now there's a lot of mystery and confusion between subchapter S and subchapter C. We generally call them an S Corp or a C Corp. And as you can see here, an S Corp provides asset protection and allows the passing of income, losses, deductions, and credits directly to the shareholders for tax purposes. Now, when it says shareholders, one of the key things here with subchapter S is that there are ownership interests that are identifiable and distributable as shares. Now, as you look at that, what it does in terms of this flow through of taxes, it is almost like the LLC, because the losses and profits can pass through and be reported on the personal tax return, but there are a few differences that I'll talk about. And so therefore the subchapter S is very simple. And as you see here, the shareholder report the flow through of income and losses on their personal tax returns. I guess I couldn't put all that on one slide, but the key thing here is that with the shares, you can raise capital by selling shares to give people an interest in your business. So let's say that your company, you start your subchapter S with 100,000 shares, and you need $50,000, and you might sell off 50,000 of those shares at $1 a piece, okay? Now, the key thing is about subchapter S corporations, they're almost never publicly traded, okay? So this is very much a way for someone who believes in your idea and wants to have an ownership interest to help capitalize you. And I always say that equity is patient money. In other words, if someone invests in a business versus loaning money to a business, they're willing to wait for a return. They're taking a risk, they're riding alongside with you, and they're expecting an outsized return, assuming things go well. But now I always tell people that equity is the most expensive money, because if you're splitting everything 50-50, if all they did was put in money and you're doing all the work, and you're splitting the profits 50-50, which doesn't necessarily have to be the case, but that's as long as they're a shareholder. Whereas if you have a loan that you repay, then whatever the payment terms with that are over and done with when it's done. So those are the three key facets of the subchapter S. All right, now, the granddaddy of them all, the subchapter C corporation, often called a C Corp, comes as a sale shares of stock to shareholders who become owners of the company. And you say, well, Tony, that sounds like the C. Typically, if someone wants to raise capital publicly, particularly through other means such as that, then they'll need to form a C Corp. That's probably one of the biggest compelling reasons for someone to form a C Corporation is because of the tax treatment that relates to the ownership by other parties. As you see here, it's named for the subchapter C of the IRS code, which lays out the rules governing corporations and their shareholders. So there are rules already, and the rules are in writing. They're in the IRS code book, that if it appears to you that you might be inclined to want to do a C Corp, then go to irs.gov and Google with a search within there, say C Corp rules, and it'll lay all that out. Now, here's the thing. If you have a C Corp, it's a lot more paperwork and I'll say cumbersome than having an S Corp. So if you're fundamentally a small business and don't plan to go out and raise a bunch of public capital, then a C Corp might be a little bit too much to speak. And now you can always transition from a S Corp into a C Corp. All right, so those are our main three, the LLC, the S Corp, and the C Corp. Now again, this episode is sponsored by the Private Money Syndicate, where we power your dreams with private money. So as I'm talking about this stuff, if you want to capitalize, particularly through debt, any of these entities that you intend to form, then reach out to us at privatemoneysyndicate.com or give me a call at 706-888-3719, and your private money godfather will help you to get all this done and help you to get the money to power your dreams. All right, so now let's examine in comparison some of the key characteristics of these three. So we're going to start off with liability protection. As you can read, it says personal asset protection, which shields you from being personally liable for business debts. I gave you the caveat earlier, and that is as long as you do not personally guarantee the business debt. So let's suppose that you didn't do that. And as you see there, that you're able to protect yourself from those liabilities with all three, the LLC, the S Corp, and the C Corp, because fundamentally they are not you. They are something for tax purposes, something all into themselves. So if they have any debt that is issued to the LLC, that's issued to the S Corp, or issued to the C Corp, then that is that entity's risk, that if anything goes wrong, all that can be taken would be the assets of the entity, none of your stuff, okay? And that activity does not show up on your personal credit report as well. So that's probably one of the biggest front-end reasons why you would consider using the entity, the LLC, S Corp, or the C Corp. Now, when it comes to raising capital, which is another key characteristic, it says that in addition to bank loans, which structure allows selling shares as a mean of capitalizing the business. And the only one that you can't do that with is the limited liability company. And that's because the LLC does not have shares. Now, fundamentally, the structure of an LLC is you form the entity, all right, and then inside of that entity, you have what's called operating agreement. Now, the operating agreement tells how the parties, if there's more than one are involved in doing their roles within the company, how any profits or any expenses of the company would be split internally between those partners. If it's more than one person, if it's only one person, then that's real simple. But the key thing is the operating agreement is what dictates how the business operates, as well as the fact that you, just by virtue of having the entity itself, it is almost, as far as anyone could consider as far as raising money, it's like you're out there trying to raise money yourself. The key thing is that those assets, therefore, will be owned by the LLC and not by you. All right, so if you go get a loan, or if you have somebody put some money into the business, it's like they're giving it to you if you're using LLC. Now, as I said in the previous slide, with the S Corp or the C Corp, you can sell parts of the company off in the form of shares. And if you're going to go do an IPO or crowdfunding, and there's some subsets of the C Corp that you could use, you would be able to do that with the corporations, the S or the C, primarily the C if you're doing it publicly, because you would sell an interest in the business in the form of those shares to whoever was willing to invest whatever the price per share is that you would issue. Now, I will say this as far as S Corp and someone investing money, because there's not a market like the New York Stock Exchange or the NASDAQ to sell shares on, the liquidity of that ownership interest is pretty, stagnant, or is not subject to change unless you buy that person out, or they want to buy more interest or controlling interest in the entity. And so from the standpoint, there is no operating agreement, but there are bylaws within the corporation, in this case, the S or the C, that dictate the model and operations of the business itself. All right, now let's talk about double taxation. You say, well, Tony, what is double taxation? I don't even want to pay taxes once. Now, why would I pay taxes twice? All right, well, here it is. Double taxations or profits taxed twice at the corporate level, then again at the personal level when profits are distributed. Now, you notice that the LLC and the S Corp do not have double taxation. That's because the earnings and losses pass through to the actual owners and they address those on their personal tax returns. However, as you see on the C Corp, as a corporation has profits, those profits are taxed. And then after taxes, the corporation can distribute profits in the form of dividends. And then once you or I receive those dividends, then those are reported on our personal income, and then we pay personal income tax on those. So that puts a pretty heavy taxation burden on the business or the person or the people involved by virtue of that. But again, I always say there's a tit for the tat. If you're planning on raising public capital and those kind of things, then the C Corp is in all senses probably the best approach for you to take. But the downside relative to the LLC and relative to the S Corp is the double taxation that would occur on any profits. You will be taxed to the corporation for having made a profit. Then as they distribute whatever portions of that profit go out to the owners, then those parties would have to add that income to their personal taxable income, then they pay tax on it as well. All right, now pass-through of losses. Well, this is kind of the opposite side of that coin we were just talking about. And so as you see, there's yes, yes, no, as relates to the LLC, the S Corp, and the C Corp. Basically, losses are passed through. So let's suppose that I had made $100,000 on my personal income. Let's say I've got a job or some other business, and here I have an LLC and here I have an S Corp that actually lost money for that year. Well, those losses can be passed through and I can deduct the money. Let's say I had a $20,000 loss in a business, so I take that off of my income from my W-2 income, and it's like I only earn $80,000, that would be taxed on, all other things being equal. So now, again, in the early stages, what happens with most businesses? Do they make a profit or do they have losses? Well, they have losses. So if you're in a situation where it would certainly benefit you to reduce your taxable profile as you go into a business, then hands down, the LLC or the S Corp will be your way to go. Now the C Corp, again, because the money does not pass through, it's all addressed and owned and taxed at the corporate level, then those losses would not be able to be passed through to the shareholders and therefore reduce their otherwise taxable income. All right, so those are those key characteristics. Now, I get asked questions, or people ask questions. Well, first of these, some of the commonly asked questions are, do I need a lawyer to set up an LLC or a corporation? And I answer with not necessarily. DIY, you can do it yourself, or use one of the numerous online services that guide you through the process. I mean, it's a paperwork drill. It's like filling out one of the gazillion applications you probably filled out in your life. But now here's the key thing, and why I started off with the definitions. You can't do a good job of answering the questions if you don't understand the question, because you don't understand the words. So use your phone, Google, and be clear on whatever the process application would be asking you for as you're deciding how you want to do this. But again, if you're uncomfortable or otherwise would just prefer to have an attorney to set yours up. In fact, my daughter, when she was actually going through law school, she was interning, she set mine up, so I kind of used a lawyer. Maybe I didn't, I don't know. She wasn't a lawyer yet, but the point is, I let her get some practice on daddy. But you don't necessarily need to have an attorney to set that up for you. You can establish it yourself. Can I form an entity for my home-based business? Absolutely, yes. Whether it's an LLC, S Corp, C Corp, you can operate a home-based business within an entity. So, so many people now work from home. Well, you can do your business from home. So just because you're at home doesn't mean that you're relegated to a sole proprietorship. Yes, you can do any of the entities that we just talked about. Can a corporation own an LLC? Can an LLC own a corporation? And the answer to that is absolutely yes. Now, you can do it either way. But now you need to know why you're doing it either way. I can't really get inside of the whys, but I do know that there are a lot of LLCs that do own corporate entities and vice versa, corporate entities that have LLCs. So if you get to that level of complexity, there's some decision making to be made, but you're able to do that. Must I have a CPA if I operate my business as an LLC or a corporation? Well, the answer is not required. Now, you have to maintain proper financial records. So if you're like me, I don't like the tedium of maintaining books and everything. So I have a bookkeeper. I don't have a CPA. I used to. But the key thing is somebody who's going to be able to make sure that all your reporting of your filings to the IRS and all that, and if you have shareholders, all that is done. So as it says, exercise prudence to ensure that your financials are in good order. So if you need to use someone temporarily to get started, then you want to use QuickBooks or any of those other software platforms, that's an option. You can do it yourself just from off the rip, or you can have somebody else to bear the burden and you just pay them something every month to make sure that everything is done properly. And so the option is entirely up to you as far as how you handle the bookkeeping aspects, but it does not require a certified what does CPA stand for? Certified Public Accountant. It doesn't require a CPA. It's amazing how we use acronyms so much we forget what the actual acronyms stand for. CPA is Certified Public Accountant. All right. What must I do after I form my business entity? Now, this is the big one. I would not tell you how many people call wanting to, get some capital and say, well, I have an LLC. And then I ask them, do you have a tax ID number for it? No, I ain't got a tax ID. You have to have a tax ID. That is how the IRS knows the entity exists. That's just like your Social Security number. It's got the same number of digits. They just put the dash after the first two instead of a set of 323. So from the standpoint that make sure that you go onto irs.gov and you get a tax ID number. Really simple. You can do it online, and don't do like I did. When the IRS sends you the letter that formally identifies your tax ID number. Now, back when I formed mine, they weren't doing it all online. Do not dispose of that letter. You will be asked for that letter again and again. But nowadays, it's online, so you can probably print off another one. But make sure that you not only know the tax ID number, but you also have the letter that establishes it. And then the next thing you want to do is that you want to register your entity with the Secretary of State. So in other words, once you have done that, after you formed it, that's a formation, it's got an identity, then you'll be registering it with your particular Secretary of State's office. So now you've done all the fundamental parts of setting up your entity to do business. Now, not on the slide because it's not necessarily required at the outset, is you need to have a business bank account that is associated with the entity under its tax ID number, the TIN. And the first dollar that you spend, or the first dollar you put into the business, include what you may have spent to form the entity. Make sure that that money flows into and out of the bank account, because that will be your owner's equity as you're putting money in, regardless of the business structure that you choose. So make sure you get a bank account that's able to maintain an audit trail and document the in and outs of dollars related to your entity. All right, where can I find help? Now, if you need some, there's a lot, and I've got some acronyms here. The SBDC, what is the SBDC? Well, every area has a small business development center. That's what an SBDC is. And they are paid by our tax dollars under the Small Business Administration to help people to do whatever they need to do to go into business. So you find your area SBDC. You can use an attorney or a CPA if you like. I already addressed those. And of course, there are lots of online information and resources that you can access that will be helpful in you doing this and doing it right. I mean, these things, these online platforms can just walk you through step by step, just as if you were sitting there talking to an attorney or talking to an SBDC person. They're going to ask you pretty much the same questions, and that goes in some of the decision making as to which entity you form, how it's going to be set up. Now, some of the things you're going to need to come up with a name and all that stuff, but it's not that complicated. But it's important that you be clear on what your intentions are, and if you can't distill which of these entities is going to be most appropriate for you to do handle things your way, then yes, certainly avail yourself to some help. And you can also find some free support on our website at privatemoneysyndicate.com. And if you just want to go to the menus tab and go to tools-resources, I got a lot of free resources that will help you to get your business going, form right contracts and all kind of stuff. Because again, our business is helping to power your dreams with private money and being able to situate yourself to be able to access private capital, because it's got to be a business-to-business transaction. Unlike the bank, I can't do business with somebody's social security number, so you've got to have an entity to be able to use private capital through the Private Money Syndicate and any of the other private capital sources out there. All right, so we've discussed the key things. What did we learn today? I hope that I've done a pretty good job of defining the entities, the LLC, the S Corp, and the C Corp. And I've given you some information to allow you to compare the different key characteristics of these so as you understand the nuance of what this one does and doesn't do versus the other. And you can be very mindful in making the selection, because some people say, I want to have a LLC, and they don't even know what LLC stands for, first and foremost, but then they don't know just between that and any of the other corporations. So there isn't a lot to know, but again, you need to know what you're wanting to do, how you want to be taxed, and for whatever the reasons why are, and those are going to guide your decision making. And then the third point we discussed were the several most commonly asked questions relating to forming a business entity. So again, this episode was a request from a viewer. And so, Tay, I hope that I answered your questions and that you're ready to go ahead and form your entity and do those things. And so, again, thank you, Tay, for asking. And to all of you, I want to remind you that this episode is being sponsored by the Private Money Syndicate, where we power your dreams with private money. Reach us at privatemoneysyndicate.com or give me a call, 706-888-3719. And if you have any questions or great ideas for episodes, because that's the hardest part of doing this, what am I going to talk about next, is reach out and give me a call like Tay did at 706-888-3719. It's going to be up there on the screen, write it down. Or you can email me at tony@privatemoneygodfather.com, or you can go to the website, privatemoneysyndicate.com, schedule a consultation, and we can talk about it. And whatever you want to talk about, I don't know, I might want to make another episode of Mind Your Business show about it. So that wraps it up for today. I certainly appreciate you tuning in and making this an important part of your viewing day. And as I always say, if you're going to go in business and stay in business, you got to mind your business, and I will see you on the next one.